Hey Cookie, how you going, mate?
I'm really good, Mark. Busy couple of months, and here we are a few days before the next RBA meeting, and the economy's a little bit better, but
What,
not good yet.
well,
Better than it was, but not perfect. A long way from perfect.
and better doesn't necessarily augur well for borrowers, because the perverse sort of thing about all this is that the worse the economy is, the more likely it is that they're going to get a rate cut. The better the economy is, the less likely it is they're going to get a rate cut. So it's a bit of a
Yep.
it's sort of like inversely related to rate
Correct.
cuts or what a borrower wants, because borrowers, probably a lot of them, don't really care about the economy. They're more interested in the economy being such that they'll get a rate cut.
Yes. And in fact, it's really interesting because you're quite right. Because over the past month or so, roughly, one of the rate cuts that was there has been now taken out. That, say, a month and a half ago, there were 3 more rate cuts priced into the market. Now there's only roughly 2.
Yeah.
And that's because if you look at a range of data, compare it with where it was a year ago. So not in absolute terms, but GDP, 1.8% now, was 0.8% a year ago.
Yeah.
Building approvals running at about 17,000 a month. We're running at 12,000 a month a year ago. Household spending, 5% annual growth, was 3%. So as we like in economics, and you look at the charts, when there's a turning point, it's good news, as in the economy is a little bit better. But we're not back where we can sort of put our hand on our heart and say the economy is good. We're not good yet, but the rate cuts are starting to work. The fact that the world economy has been really resilient to the tariff wars, if we can even call them that nowadays, is helping Australia.
It's called
Tariff
posturing.
posturing. I like it. Yeah.
It's posturing. I mean, it's worked.
Well, and the fallout has not been as bad as, remember Liberation Day back in early April?
Yep.
Stock market tanked, bonds were going crazy. The UK was, all in all sorts of trouble. Sort of the implications around the world were huge. There was a bit of a deep breath taken. And I think the central banks have helped because we've had rate cuts in many, many countries since then. So they're obviously helping the economy. And here we are, US stocks at a record high. The ASX is just below a record high. A bit of volatility there. But, and as I said, the economy's picking up a bit. I don't want to overstate it, but we're picking up a bit.
Well, let's just have a look at it for a second. Like, the way the RBA always likes to look at these things, and they tend to do it in a structured way, is they look at the international markets.
Yep.
That's a really big part of their thinking, or their ultimate deliberations. So internationally, what's going on? Let's pick up our biggest trading partners. So let's look at China for a start. Look at Asia, China, but let's China being our most dominant trading partner. So how are things looking there? Because the better they are there, the more we're going to export, the more likely it is going to increase our economy and our GDP, which is going to therefore less likely to have a rate reduction.
Correct. China, which was in a bit of trouble at the start of the year, like most other central banks, the People's Bank of China, the central bank there, they've cut interest rates. They have a thing called a reserve requirement ratio, which is the amount of money that banks are allowed to lend. So it's sort of like the old-fashioned days where
reverse deposit.
You can lend X billion yuan or Y billion yuan. They've eased policy, so there's more credit available.
So there's more money supply.
More money supply in the economy. The economy has found a bit of a base. There's still basically 0% inflation. So they've got this problem with inflation being too low, but bottom line GDP is picking up. And from what you quite rightly said about our real dependence on China for our exports, so that's why we look at things like iron ore price. 2 months ago, $95 a ton. It's $105 a ton. So that better news in China means that the iron ore price, some of these commodity prices have picked up. We've actually had much better export data in the last 2 or 3 months. So that's money for the Australian economy. So again, it feeds into this narrative that I think we've sort of already alluded to in the first few minutes, that there is a turning point in the economy, long may it last, and it still needs to be built on before we can sort of say, yep, we've got the economy back where we want it. We're not quite there, but we're moving in that direction.
And where do you think, well, just on that, in terms of markers, in terms of measurement, where does it need to go after which the Reserve Bank starts to get worried. So, I mean, it used to be in the threes, but it's about, where if it were 1.8, do they want to see like 2.7, 3.2?
It's even lower. That was that funny thing. Remember in the last statement on monetary policy when they revised their productivity numbers down quite dramatically? And that was sort of like the highlight of the statement, not necessarily what they're saying about interest rates or inflation. They're saying that productivity is crap.
Yeah.
And yes, the data confirm that. We've had basically a decade of really poor productivity. Why that matters is that lower productivity lowers that speed limit for GDP growth. And you know, you and I have spoken about this for many a long day. In the olden days, you know, that 3% GDP growth that we grew to love and enjoy, and that was a good economy, was based on productivity, 1.5% annual growth, 1.5% sort of other bits and bobs going on in the economy, so you could go 3% in real terms. The RBA reckon that's in the low twos now. They've trimmed off at least 0.5 percentage point, maybe 0.75%. So they're going to be saying for the here and now, if we get GDP growth at maybe not 2.25, but if we get it at 2.5, they'll say, mission accomplished. We're growing.
So no more rate reductions.
If we get that GDP momentum over the next 2 or 3 quarters back to 2.5 from the slightly below 2% that we're getting now.
So maybe you could explain why that's important, because, like when you look at if we can get GDP, let's say for argument's sake, to 2.5.
2.5, yep.
And which may be the sweet spot for the RBA. And if productivity, though, stays, in the very low 0.1, 0.2, 0.3, maybe explain what flag that puts up for the RBA relative to interest rates, because and how that sort of bleeds into inflation potentially.
Yeah, really good point. It's all about the thing in economics, the speed limit at which the economy can grow. Some people ask, why don't we just have the government or the Reserve Bank print $50 notes, drop them from a helicopter, or put, 10 grand in everybody's bank account, we're all going to be better off. Well, sounds good, but the reality of that is that we would all go out and spend it, most of it. I know I would. That would fuel economic growth for a very, very short period. Every shop would sell everything they've got. But it means higher inflation, and it means the economy grows too strongly, too much of a good thing. It's sort of like Easter Sunday when you've had 3 or 4 chocolate eggs, have a 5th and 6th. No, too many, and you feel crook. That's what happened in an economy too. You can have too much of a good thing. So that's why the RBA looks at this GDP, looks at the productivity, and sort of says, well, if we're growing at above 2.5% annual GDP growth, it's probably too strong. So put it this way, certainly above 3%, they would sort of say, look, we are growing too strongly. We need to put on the brakes, put on the policy brakes, just to cool that spending down a little bit, to cool back that pace of expansion of the economy, because it's too strong. And indeed, if we look back to 2022, when we came out of the pandemic, everybody had saved some money. We thought, yippee, we're out, we can go and spend. And, we're out of this bloody lockdown and all this other stuff. The economy went whoosh. And that's when we had that inflation problem. So that was part of that. And it wasn't necessarily a mistake that the government did or the Reserve Bank did, necessarily, because we were coming out of a pretty bad pandemic. But then the reality check is that you and I and everybody listening sort of said, well, thank God we're out of this pandemic. I'm going to go on a holiday. I'm going to buy that new car that I put off been buying. I'm going to buy some new, bits and pieces.
Go to the restaurant.
Go to the restaurant again at last. I can go out and go and have a few beers at the pub. And whoosh, the economy went really strong. Inflation kicked up. And therefore, that's why we saw the RBA hiking 425 basis points.
So if productivity was higher,
yes,
and let's say, we're at 2.5% GDP growth,
yep.
And if productivity though was higher, is it fair to say that the Reserve Bank doesn't mind that, because they're going to say the manufacturers or the merchants are getting more of the product, therefore they won't be putting prices up because they can make the same margin just by selling more product.
Correct.
But low productivity is a bit of constraint on GDP in terms of what's acceptable GDP.
And productivity is about your ability to grow the economy without adding to inflation.
Yeah.
So one little example, I'll use this because it sort of makes the point. in terms of labour productivity. Just say you got 10 people, you give them a pick, a shovel and a wheelbarrow and say, in the Pilbara, start mining iron ore. You're not going to dig a lot of iron ore out, are you? Same 10 people, but the company buys a couple of diggers, a couple of trucks and a couple of crushers and all this stuff. I don't know how you get iron ore out of the ground. You get it to the port. Imagine the productivity growth. So you only got 10 workers. Your tonnages per week or per month would be massively higher with the machinery and equipment. Your productivity, just because you've invested a couple of $1 million in machinery. Is that inflationary? No, it's actually growing the business more quickly because you've got better productivity enhancing tools. So, the workers obviously got to have the skills and knowledge to run the machines. How do you work the digger? How do you get all these things working? But it's the machinery as well, which comes back to this point that I think we discussed last time at that productivity roundtable that Treasurer Jim Chalmers had, is that part of this issue of productivity is getting the private sector and the government investing in machinery, equipment, AI, technology to make sure that we as business people, we as consumers can do more in the same amount of hours because we're pressing a button or we're using machines to do some of the work for us.
So we therefore probably have, given our current productivity demise,
Yep.
have to probably be prepared to accept a lower GDP growth number, and therefore that's where the Reserve Bank is. And the closer our actual GDP gets to that, their sweet spot, the less likely there will be a rate reduction.
Correct. I think that's, in a nutshell, in 50 words or less, however many you said, that is the dilemma right now for the RBA.
Yeah.
They would sort of like to cut interest rates, I think, because they're pretty confident that inflation, aside from the monthly volatility, is sort of tracking in the middle of the range approximately. We had Sarah Hunter, the chief economist at the RBA, talking a few days ago. We had the governor herself speaking at the House of Reps parliamentary committee on Monday. She was saying a similar sort of thing. They'd like to, but they're just a bit cautious about overstimulating the economy before they're confident that, one, inflation's locked in, two, that we're getting some sort of productivity response, which isn't yet happening.
Yeah, the inflation sort of looks like it's locked in, but we don't know because that can change quickly. But
yes,
but the productivity thing is one thing is for sure is not locked in.
No, and productivity is one of these things that takes a long time to change.
It's a big turnaround time.
It's one of these things that so I think one example of productivity is the skills of your workforce. It's all very well, and I've heard a number of businesses, particularly a year or two ago, saying, I've got this great business plan, I've got all the CapEx, I've got my finance approved, I'm ready to rock and roll, but I can't find the workers with the skills that I need to get it off the ground. And that was with 600, 700,000 people unemployed. So that goes to show that we've got to ensure that our kids from kindy, can read and write and add up, through to school, through to university, through TAFE training, through all the skills and knowledge. Because the economy, I'm blown away by artificial intelligence and technology and all these sort of things. I love them. I think they're fantastic. But we've got to ensure that our workforce has the knowledge, the agility, as Malcolm Turnbull used to talk about, the agility to adapt to a changing economy. So, I used to be a bricklayer and I'd lay bricks like this. Well, if there's a machine that can come along that lays them double the speed and, great. If there's a way of doing business, banking and finance, remember checks and ATMs pulling cash out. Now it's tap, 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 tap. How efficient is that? So that's what we need to embrace and make sure that people can understand how it works. And I think that's part of this, bigger picture productivity thing. But again, think about, getting the workforce educated. It takes a long time.
And immigration.
To train them. Yes, and the immigration. Are we getting the right people in terms of our skill set? Just put it, if we focus on the skills of the immigrants, are we getting the skills that we need in the 300,000 people that are coming in each year?
So that's interesting.
To do stuff.
If, given that we've still got record levels of immigration.
Still very high. Yes, correct.
What would you say, instead of saying, maybe it's just a narrative change, but we're going to keep the immigration levels as is, but we're going to make sure that the people who are coming in are 300,000 people, for example, who have skills into the 10 categories we need them in.
Yeah.
Otherwise, it can't get
building and building and construction. So we need
yeah.
sparkies and carpenters and
Yeah.
bricklayers. That we need it to build all these houses that we need to build, for example, and then all the infrastructure that we need.
Is that more like
the government would say? The government say they're doing that to a point. The reality is that it's not quite as clear cut as that. So again, I don't know quite what the criteria is that if you apply to come to live in Australia, say yes, I'm a tradie, or I'm a doctor or a nurse or a teacher or whatever. I don't know how they check that. And they say, oh yeah, you're a teacher, come on in, and then they realise that the certificate that person might have had from country XYZ isn't compatible with our education system. So there's that matching the skills. So we think that they've got the skills, but the harsh reality is that when the new immigrants get here, some of them, and this is the discussion that's going on with the Business Council and others who are sort of the ones who are at the coalface of, I need skilled workers and I can't find them, at the coalface of this immigration discussion.
So what's interesting, you start off talking about the markets priced in. They were pricing in 3 reductions. They're now pricing in, 3 or 4 actually. They're now pricing in 2.
Barely 2.
I think what our audience needs to understand, or maybe we could just touch on this, but they maybe already understand, but how many times you and I have talked about the market saying there's going to be a rate reduction or a series of rate reductions. I mean, I remember 2 years ago we were talking about 7 rate reductions at one stage.
Yes.
And we got none in that period that they're talking about.
Correct.
And I don't really think the RBA cares too much about what the market says. And to some extent, given what we just talked about, do you reckon that we really need to consider what the market says anymore? Or should we just look at because the RBA's position is they're not preemptive anymore. They are data response. You give me the data says we're here, we'll make a move one way or the other off the back of that.
That is spot on, by the way. That is exactly 10 years ago, it might have been a little bit different.
Oh, it definitely was different.
They were preemptive. Now they need to see the data before they pull the trigger one way or another. Yep.
And when they were preemptive, they were looking at money markets. It was rare
correct.
that the RBA went against the money market. If the money market was intensely saying there's a 99% chance that we need a rate reduction, it was rare that the RBA would go against it. Now the RBA couldn't give a damn.
I just think 2 meetings ago, it was 90% priced in.
That was the July meeting. Yeah.
The July meeting, yes. I was tracking my dates.
Yeah.
Yes, that was one of those ones where I think the new operational standards, if we call it that, of the Monetary Policy Board of the RBA says, well, we glance at the markets. They look at the markets. They look at the Aussie dollar. They look at everything. But because the market's got a 90-something% probability of a rate cut, and they look at that and say, well, hang on, we don't think it's justified. So they'll say no. And then, of course, the governor does her press conference so she can articulate why. And I do recall that she got grilled on that, and fair enough too. And she justified the case pretty well. She said, well, look, we're
not ready yet.
We're not ready yet. It's not the direction, it's the timing, I think she said. Yeah, we still think we need to cut.
Well, she wanted to wait for the July numbers to come out.
Correct. You got it.
So I think the meeting was on the 8th of July, something like that, but the July numbers for the June period and for the previous year were coming out
July,
to the 28th of July or 29th of July, something. And when she did meet the next month on the whatever it was, she did reduce because she got the right numbers, but she pushed against this process of understanding or knowing what money markets are saying. So we might just go back to the money markets for a second. Maybe we can sort of semi-explain, because I don't think I know, and I don't know if you have that bit of knowledge of it, but money markets sort of feed a whole lot of data in daily, not hourly.
Yep.
And they're, and there's the data sets are being fed into some sort of, probably AI these days, but some sort of machine that is learning and making deductions as to what it thinks the market's going to do at that particular day in terms of pricing their own money.
Yes.
So the money market's pricing their own money relative to transactions that are being made between parties in the money market. It's not necessarily saying you, the audience who have a mortgage with, Westpac, your interest rate's going to get reduced in 3 months.
Yes.
Maybe you could explain that a bit.
There are a couple of – that is spot on. The banks – let's get back to the function of banking. They receive deposits. They're the intermediary between money in, money out. We all use a bank. Here we go a minute ago talking about tapping. That tap is money being transferred from my NAB account to Woolworths when I buy my groceries, or to Shell when I fill up my car with petrol, or whatever it is, my automatic debit for my electricity bill, whatever. That is still money. It's still, even though it's not notes and coins like back in the day, it is still a transfer. And what the banks do when they have a surplus of cash, for example, just say in this particular day, there was more cash going in, more money. And by cash, I mean
Money.
transactions, not the cold, hard stuff. If they've got a surplus of money, they don't want to hold it earning no interest.
They don't leave it in a
overnight.
check account.
No, earning no money overnight. So they'll probably go to the counterpart XYZ Bank and ABC Bank.
Who might need some money.
Who think, oh, gee, we're a bit short today because we had more outflows. People sort of took more out of our accounts, and we wrote, a whole lot of mortgages today, so the money went out of our accounts. We need to borrow the money. And this is where the official cash rate works to an extent. So that's how the market clears when the banks settle their daily accounts at the end of the day with normal, regular, plain vanilla transactions. Now, there's also this issue that the banks, because they can forecast some of their, they do forecast some of their ins and outs. They know when, we've got all these mortgage repayments due on the 10th and the 20th of the month, and we've got a whole lot coming through, and there's a 3-year fixed deposit that's coming to an end, or a 3-year loan that's coming to an end. They look at this stuff all the time. The treasuries in the banks do that every day of the week. In fact, more than that. And they can sort of see what's going on. And then plus that data flow in. So it's a combination of their own internal balance sheet functioning, cash in, cash out, future cash in, future cash out. Plus, they might talk to their economics team and say, oh, gee, our data is showing the economy is really strong. So, for example, they monitor their credit card data. Oh, gee, there's been a pickup in our EPFOS transactions over the last 2 weeks or something. There's something going on here. They'll feed that all into their positioning of managing their multi-billion-dollar balance sheet, and that can cause these future prices to go up or down to price in, as you alluded to, 2 more rate cuts by March next year. Oh, we're taking them out because we've got a change in our cash flow. So it's a combination of, it's not just you and me or, good old Chris Joy speculating if there's going to be a rate cut or not. That's fine, and that's part of it. But it's also real money flows. It's actually this is actually the economy sort of telling the central bank and being priced into the market what's happening in the economy as well. So that's a really, really important point to think about too.
Yeah, but it doesn't necessarily follow that they get it right, because this can change.
Yes.
It's a hourly thing. It changes by the moment.
And this is the beauty of the unpredictability of a lot of these cash flows. So I mentioned before that the price of a ton of iron ore went from $95 to $105. If you're one of the banks that is the banker for the big iron ore companies, they buy and sell currencies and put deposits, the big BHPs and Rios and Fortescue and all these others, their businesses have cash flowing in and out when they sell a million tons of this stuff. That has big implications for the bank's balance sheets as well. We thought it was only going to be 95. Now it's $105 a ton. That's a 10% increase. So on many billions of dollars of exports, that's many billions of dollars extra that can be coming into the economy, into the system. So it's not only the banks that are trying to, massage and manage these expectations. It's us economists looking at the economy. But this is where the bank treasury departments within each of the big and the small banks monitor cash flows to work out what their funding requirement's going to be.
But it doesn't necessarily follow that, because there might be we might have a month of a lot of inflows, for argument's sake,
yes,
of cash. Whether it's coming from overseas or it's coming from people spending more money in their credit cards, whatever the case may be.
Yep.
Running down their savings because they want to spend. It doesn't necessarily follow that the Reserve Bank's going to say, because the Reserve Bank, by the way, has access to the same data, but it doesn't necessarily follow the Reserve Bank's going to say, well, wait a minute, we're flush and there's an inflation problem potential, because the Reserve Bank's made it pretty clear we're we're actually going to measure inflation, and we don't necessarily want to measure it monthly either. We rather have, it looks like they want to have the quarterly information.
Correct.
And the quarterly information doesn't come until the end of the month after the quarter finishes. So like the September quarter, that's July, August, September, comes out for the September quarter, comes out at the end of October.
Correct.
Which is next month. So they like to see that data. The Reserve Bank's made pretty clear that these days she wants to see, the whole board, I guess, they want to see the actual effect on inflation, not what the money market is predicting.
Correct. And it's fun, not funny. It's interesting you mentioned that too, because for 50 years we've had monthly employment data. This is just me sort of learning how the new operation of the board is working as well. A lot of us can get very excited about one monthly employment number. Oh, it went up to 4.3. Oh, gee, employment was down 6,000 in the month. The RBA wouldn't give two. I'll be general. They wouldn't give two hoots about that. And it's not that we don't get quarterly labour force numbers, but you can turn monthly numbers into quarterly numbers, and you can put rolling averages through. You can analyse these numbers 100 different ways. And so when you listen to the RBA governor and the senior RBA officials talk about the labour force numbers, very rarely do they say, oh, the month of August, the unemployment rate was this, and therefore that forces to hold rates, cut rates, whatever the case may be. They will say that over the course of the last 12 months, employment growth has slowed, the unemployment rates trended. So putting a moving average type measure through these seasonally adjusted monthly numbers has trended from 3.9 to 4.2. Therefore, that's why we cut interest rates last time. So your point, which is spot on about the quarterly inflation numbers, can apply to the noise, if we can call it that, in the monthly employment numbers, inflation numbers. They want to get the trend, not get excited about, 1 month's up, and then, lo and behold, next month it went back down. So the trend is flat, and so they tend not to get carried away on that.
And it seems like they want to look at the trend for your top three. So they're looking at the trends for both for all of GDP, inflation, and labour market or unemployment,
Correct.
Which we'll look at in a moment. Now, just before we go to the board, though, I just want to raise. Well, there's two things. I want to park property prices. We'll come back to that. We'll park it for the moment. But in terms of monthly numbers, maybe you just can remind us, what do we get monthly numbers on, and what do we get quarterly numbers on, and which do you think the Reserve Bank is taking the most notice of in relation to, let's say, the top three categories: GDP, inflation, and unemployment? Bearing in mind, I just want to remind everybody that unemployment is now a measure of full employment, or start again. Yeah, well, that's right. I mean, they use unemployment as a measure of their success at their new mandate about full employment, whatever that means. So that's a much more overriding thing than it has been in the past, since this time last year, I think.
Correct.
So maybe, just with that background, what are they looking at? Because we're going to get some monthly numbers today on inflation. We've got monthly
labour force numbers in a couple of weeks' time, and then the quarterly GDP figures came out 2 or 3 weeks ago, and I think how I would categorise it, and again, when we get to the board in a minute or two, there are basically, if you were to say to the RBA, there are only 3 indicators that you could have to make your monetary policy decision. Of course, there are
all 3 though.
But you need all 3. Yeah. GDP doesn't tell you everything.
Yep.
Unemployment doesn't tell you everything. Inflation doesn't tell you everything. Particularly, again, as you touched on, that the Reserve Bank mandate, with that revision to what the Reserve Bank board does nowadays, is both inflation, 2 and 3%. That's something that we've grown up with over the last 30-something years, whatever it is. It's now also full employment. So I think that up until a year or 2 or 2 or 3 ago, inflation probably had a weighting of 75%. That was the thing that drove them. And 25% was a bit on the economy, a bit on GDP, a bit on global, a bit on other bits and pieces in the economy to sway them or convince them to move rates up, down, or keep them steady. Nowadays, I reckon it's gone, probably inflation's still the critical one. So it's probably dropped to 40%. Labour market's up to 35%, and it's still 25% other bits and pieces, retail sales and building approvals and global. So I think the importance of those labour force numbers is much, much greater today than it was a couple of years ago. But, and this is the dilemma. Anybody who's tried to juggle three sometimes conflicting things realizes it's bloody hard to do. And this is what's happening in the US, just by the way, because they've got higher inflation and higher unemployment. Do you cut rates because of unemployment, or do you hold them steady because inflation's picking up? And that's what the problem of the Jerome Powell, the chairperson.
And the deal with Trump.
Yes, indeed. And that's a dilemma that the US has at the moment. That's sort of filtering into Australia a little bit right
I could
now.
say it's a dilemma here too for opposite
yes.
reasons. So, because I think what we shouldn't explain to our audience is where GDP, inflation, and labour market, why they matter from a policy point of view. And I might just have a little crack at it, and then you please correct me if I'm wrong. So the actual mandate for the RBA is the prosperity and welfare of all Australians. That's it. They're the words.
Yep.
Prosperity and welfare. So if I'm, looking at how well I do as the chairman of the board of the RBA in relation to my mandate, our mandate as a RBA, how do I measure, for argument's sake, welfare? Well, one way I can measure welfare of all Australians, in other words, that tends to indicate looking after people who have a problem. We're not looking after the rich people. We're going to look after the welfare of Australians, make sure they're okay. Okay, so one way I might be able to measure that, objectively, let's call it, is inflation, because inflation really affects the welfare of some socio-economic bands in the Australian economy. So one way I can measure the welfare of all Australians is inflation. In other words, if it's too high, there's a lot of people who just can't keep up with the cost of living, and they're going to go backwards. The standard of living will go backwards. The other one for welfare is also labour market. Unemployment is a great measure of welfare.
Yep.
And I feel as though they've been given a lot of weight, probably under the Labor Party in Australia.
Sure.
Now, GDP, though, tends to, when GDP is strong, and depends what strong means, but let's call it 2.5, that tends to be a measure of prosperity.
Of national prosperity.
National prosperity, not individual prosperity, but national prosperity. Now, this is the game that they're playing. They're playing this game. They're saying, well, on one hand, we want all Australians to be prosperous, but on the other hand, we don't want any one category not being prosperous and therefore we need to try to look after their welfare. And then government comes and overlays their own, let's call it their own ideology in relation, whichever the government, Labor, Liberal, whatever you're talking about, their own ideology, which is sort of my explainer for why Trump is belting the hell out of Jerome Powell, because Jerome Powell is more like our current Reserve Bank, looking at unemployment and inflation. Whereas Trump's sort of saying, well, I'm interested in prosperity.
I want the economy to grow fast.
And that's my measure.
Yep.
I'm more interested in the prosperity of America.
Yep.
Of America, the nation, as opposed to...
I want the stock market to go up. I want GDP to go up. I want everything to go up.
And I want us to control everything.
Lift most... What is it? Rising tide lifts all ships, or whatever.
Most ships, anyway.
Whatever. Yeah, most of them. Yeah.
So we now have a sort of like an ideological issue between, let's say, Australia and let's say America, in relation to the role, because the Reserve Bank and the Federal Reserve, they're independent bodies, but at the same time, it's the individuals who make the decisions in relation that are on those bodies, and governments influence that. Whoever's in government can influence that. Like in America, Trump will just fire you. Like, it doesn't really matter. It's probably not going to happen here, but nonetheless, it's maybe you could just sort of give us a bit of colour around that, Steve.
Look, I think that's a great summary, and as you were talking through that, you made me think of a couple of different things. Yeah, high inflation is bad. And we saw that a couple of years ago.
By the way, for everybody.
It's a cost of living problem. I can't afford to buy my groceries, my insurance, my electricity.
For most people.
But yes, for many people,
some rich person doesn't give a damn.
But for most people, and that's where that welfare of all Australians comes into play.
Correct.
So the RBA is not going to adjust interest rates for I was going to call it the BRW rich list or whatever, but you know what I mean, AFR rich list. They'll be fine. They want to adjust interest rates and economic policy for the masses who are
So
feeling from
is
high.
it an Adam Smith? Is it like, are we talking about an
sort of.
Adam Smith style? Who is fitting into the category? How big the category of all those Australians that we need to look after?
And it comes back to this other commentary. We need to grow the pie, the size of GDP, and make sure that the extra growth is reasonably well distributed.
Yeah.
So that some of the poor people get a few of the bucks. Good, it's good for the society. We're a decent
There's a
country.
dividend prosperity
Some people get
dividend
rich,
for everybody.
Good luck to the rich people getting rich too. Fine, absolutely fine, as long as they're not getting rich at the expense of the poor. And I think that's, gosh, that all sounds like bloody motherhood statement here.
No,
but it's true. I must confess, I get very upset when I see homeless people, and you hear the stories occasionally in the media. Some poor buggers, they have sleeping in cars, and you think, geez, that's not good for a country like Australia. I think we need to look after people like that. And generally we do. We've got a pretty good system in Australia. Not perfect, but pretty good.
Well, you can't perfect it anyway.
And so therefore, the other thing that you were touching on, if you want to get inflation really, really low, you hike interest rates. If you want to get unemployment really low, so give everybody a job so they're earning money, you cut interest rates. That's the simple, as you were talking, that's the simple thing that I thought about. So do you cut interest rates to create full employment, or do you hike them to keep inflation low? Because both of them are good things. Low inflation's good, low unemployment's good, but and this is the old Phillips, I'm going to talk about the Phillips curve,
which is not really
a trade-off between inflation and unemployment.
Well, we've got to be careful about the Phillips curve in economics.
I know.
It's not that generally accepted.
It's not anymore.
No.
Mate, I did uni 35 years ago.
Yeah, me too. That was the first we did in first year.
Maybe more, I can't remember. Jeez, I'm getting old. Anyway, but there is still something, maybe the traditional Phillips curve is obsolete, but there is still a trade-off between full employment and inflation. And if you want full employment, you want everybody who wants a job to have a job, which is sort of a decent definition of full employment. Well, you cut rates. But then, as we were saying before, it's like pumping money into the economy. Inflation goes up and up and up, and that hurts everybody else. So this is what the Reserve Bank Board do every
They've got to wrestle with this stuff.
Correct. And that's why we've got this checklist, and that's why we talk about GDP, labour market issues, inflation, because sometimes they are conflicting. And you get high inflation with high unemployment. That's stagflation. That's the worst of all worlds, because what do? Do you hike interest rates to make unemployment even worse? Well, that's pretty bad. But you get inflation down. Or do you cut rates to get unemployment down, or inflation gets even higher?
Which is why stagflation is such a problem.
Which is such a problem why it should be avoided at all costs.
Because it cuts right across the welfare issue.
And it smashes everybody. Yeah. It's a horrible thing. Yeah. So this is where you come back. And if I can just take a step back, because the RBA will not update their forecasts next week. It's the meeting after that on Melbourne Cup Day, early November, that they update their forecasts. But the most recent conversation about forecasts, and again, all my mates in the money markets, all the bank economists, whatever, if I glance through their forecasts, they're similar. And if I can take a step back, because this is something that occasionally we should be happy about, based on the assumption of 2 more rate cuts, this time next year, second half of 2026, without pinpointing a quarter or a month or anything, GDP growth will be 2.5%. The unemployment rate will be a little above 4, and inflation will be 2.5. So I've got GDP 2.5, inflation 2.5, unemployment, 4 and a bit. That's actually pretty good with 2 more rate cuts. So if we can achieve that, and again, this is this magic wand of economics that we occasionally talk about. So if you're the economic dictator of Australia, and you said, well, not necessarily how you would achieve it, but what would you'd write on the board here, what's your target? I'd say, what I'd say, 2.5 GDP, maybe 2 3/4. Yep, so decent GDP growth. I'd want unemployment below 4%. I'd want inflation to be 2.5. If I could achieve that, I think you'd get the thumbs up. And this is the discussion too, just by the way. Well, the RBA, despite my criticisms of them in the recent past, might have actually got it right. I might be the one that's sort of going to be wiping that bloody egg off my face. And the RBA can sort of say that if we do get 2.5 GDP, 2.5 inflation, 4% unemployment, that's pretty good.
And but as you know, as well as I do, it won't last.
It won't last, yes.
Because
yes, and sustaining it. Mark, you're spot on. It's how how do you not you get it for 1 quarter? Fine.
Yeah.
We want it for 5
The
years.
question becomes,
Yeah.
you're correct. I mean, once we're there, then it's just started. That's the game
Yep,
that started. I mean, like if we get there, but like, and I, you and I talked at one stage about 3.5, I think,
Yes.
and 3.5 wage growth too. So like,
Indeed,
you know, it was all sort of because that wage growth percentage keeping up with inflation or maybe just staying a little bit ahead of it's very important relative to the welfare question and also the prosperity question, because people are more prosperous if they can stay ahead of the
wages
game.
are a bit above inflation, even by a little bit, even by 1% a year.
Yeah.
That's good. And in fact, prior to that inflation, COVID, pandemic disaster that we had, from the period from the early 90s recession through to 2020, so just prior to the pandemic, I think of those, 26 years approximately. I did check this the other day because I thought, because I like celebrating the Australian economy sometimes. I think of those 26 yearly observations, wages growth exceeded the inflation rate in 23 of those 26 years. And that the total cumulative increase in real wages over that 26-year period from 1993 to 2019, I think it was, I'll just double check my numbers, was an increase of about 25%.
Wow.
So
that's a standard of living.
Real wages.
Well, that's a standard of living increase.
Correct. And that's why, in some years it was a bit down, some years it went really strong. And, and again, there's swings and roundabouts that happen, in a cyclical sense. But if on balance, you're getting more pluses, you're getting 23 out of 26 with a plus sign, real wages increasing, that's how you build wealth. Get rich slowly sort of thing is what the sort of mantra is. And that's why that inflation target's important. It's why, full employment's important.
So let's have a look at the board. I mean, I do say though, Koukie, like I think it's important. That's why I wanted to just quickly touch on stuff. I think it's important for people to get a sense of why the Reserve Bank is doing what it's doing, and I could probably even go one step further. When they drafted the legislation around prosperity and welfare, I think probably what was going through the politicians' minds at the time was, what is the best way we can establish a standard of living that doesn't go backwards? And in order to do that, we want the standard of living to increase, but at the same time, we don't want it to increase at the expense of other people, some part of society. So we'll have this prosperity, welfare, checks and balance thing, always there.
That's really important. And you might recall that Jim Chalmers did talk about, I must confess I haven't followed up on where the progress is, on measuring the economy not by GDP, but by well-being. And that includes things like life expectancy, our health, our, educational attainment, these sorts of things. And again, it sounds a bit pie in the sky, but in a way, what's the point of having a really rich economy if it's, one, not sustainable? I'll go back to another example from my Economics 101 days many years ago. An economy can become really rich if we chop down all our forests and export them. When you chop down the last tree, you got nothing left. So again, I'm not a radical greenie or anything like it, but again, it just goes to show that economic growth's got to be sustainable. It's got to be able to be continued, not just for 1 year or 2 years where we're all, making truckloads of money.
And intergenerational.
And intergenerational, because what are we left for our kids? And Mark, thank you for raising that, because that is the other $64 trillion question, billion-dollar question, that at the moment, I'll put us in the slightly older category. We've been I've been lucky.
Me too.
In my life. I've been really lucky. I bought a house for $60,000 all those years ago, and kids say, "Why didn't you buy 10 of them, Dad?" So it's all I could bloody afford. But
but I still got one.
But
that's important.
Indeed, I still got one, and been lucky with life. And the kids now sort of saying, "Oh, gee, I can't even afford to buy a little shoebox for more than $500,000." And that intergenerational thing is very, very important, that we look after our young folk. Again, that's not for the RBA to do just by the way, because they've only got interest rates. That's actually for the government of the day. Again, Labor, Liberal, I'm not even going to get there, but how do we make sure that there's a bit of fairness for young folk and not too much benefit, I suppose, to old folk? And that's sort of a really thorny question.
Well, I'm going to interview John Howard this
fabulous.
week. And it's interesting. I will be asking him
Yes.
about that sort of stuff because his government was
Yeah.
quite instrumental in a lot of superannuation concessions. In
Yes.
fact, it was his last term where I think they agreed to $1 million
Contributions or something.
contribution
Yes.
right at the end of his term. But and it's interesting, to some extent that has contributed to the mismatch between, let's call it, the banker mum and dad and kids
Yep.
today. I mean, to
Yeah.
some extent, and
Yes.
maybe it's gone too far. Maybe it went too far.
Maybe it did go too far. And again, I'm a massive fan of superannuation, by the way. And to get people to put money into super, you do need a few little tax breaks. You do. And
You've got to encourage it.
Tax policy theory disclose that every single time. So if I get a little bit of a tax break by pumping in an extra few bucks every year into my super, great. That's a price worth paying for the government. However, like all policies, you can overshoot. You can make it a little too generous. And I think, in hindsight, maybe it is a little too generous, and that sort of superannuation that people have got now is at the expense of young folk.
And that's one of the things I'm going to be talking to him about tomorrow.
I'm looking forward to hearing that when it comes on.
Yeah, it'll probably
stream.
come in about 3 weeks, but
fantastic.
It's taken us a while to get John, but it's going to be great to have a chat to him about it. Right, Kooky, let's look at your board, mate.
The board, the monetary policy checklist.
Yeah.
Okay, let's have a look now. I was actually thinking about this yesterday when I was sort of preparing for today. And I think a couple of things have just sort of come back more towards neutral rather than the easing side. Because as I said at the very beginning, some of the economic news is a little bit better today than it was 3 months ago.
Economic news better, not for borrowers, though.
It means less or fewer rate cuts.
Better for the economy.
So I'm talking about the economy. We want a good economy, but it means fewer rate cuts. So GDP, I'm putting that into the neutral category. I think last time we were here, I had it erring towards easing, but as I said, GDP's picking up. Good news. Inflation, I'm putting that towards easing. We do have inflation pretty much in the 2 to 3%. Again, the monthly volatility, the quarterly numbers. Look, I'm pretty confident that inflation is in the band, and that is a reason why the RBA still. And again, this is Michelle Bullock and Sarah Hunter and others from the RBA have been saying, we're going to cut, but not just yet.
Yeah, because they're saying right now the interest rate is not neutral.
It's a little above neutral, so they want to get it towards neutral so that the economy can be in this, what do we call it? Goldilocks scene. Labour market, I'm putting that slightly towards easing. Our unemployment rate's gone from 3.4% a couple of years ago to 4.2%. Employment's slowing down. Job vacancies, job ads are slowing down. So again, not bad, but just for what the RBA is thinking about, to maintain that, we need to sort of give a bit more monetary policy stimulus.
And just on that, I think somewhere I've read that Nehru's been revised down. The non-accelerating inflation rate.
I don't know if it's official, but I think when in the House of Representatives testimony on last Monday, the governor and her senior people who were at that meeting, at that quizzing from the politicians, alluded to that. Yes, I don't think she actually sort of said a number specifically,
but it's getting.
But they're saying we think it's lower than we were assuming or estimating previously,
which was I think 4.5.
I think it was 4.5, and it's probably
sort of coming back
4.25.
Yeah. Well, we're there.
Well, and we're there now, which again goes towards the rate cutting, and proof of that. The beautiful segue into wages, which I'm putting in neutral. Wages growth 3.4. That is the Goldilocks number. It's that number, and that employers are happy to pay their staff. If profits are good, the economy's doing okay, I'll pay 3.5. Workers, if inflation's 2.5, I'll get 3.5. It's sort of that number that's not thumping employers. Wages costs are too high, or workers saying, wages are too low, I can't afford to buy anything. So I think wages are sort of Goldilocks. So that's a good news story. International economy, I'm putting in neutral. Maybe slightly towards easing, because we have had the Fed cut, and they did signal there are more rate cuts to come. Bank of Canada's cutting.
But they're much higher than us anyway.
They are higher, correct. Canada cut. Bank of England's got the poor UK economy, that's for another day. They're probably going to cut. New Zealand economy is weak, so comparable economies to us are still cutting. Some of them are a bit below us, some are a little bit higher than us. China, we mentioned, doing a little bit better, but still got very low inflation. So that's, you certainly wouldn't hike because of the world economy. It's erring towards easing. House prices, going to put that slightly towards tightening. We didn't really talk about house prices, but there's no doubt that in the last, 3, 4, 5 months, there's been an acceleration in house prices, even in Melbourne, which had been really poor for several years. And the boom cities, Perth, Adelaide and Brisbane, which had a bit of a cooling off late last year, early this year, are now on the way up again. Prices there going gangbusters.
But I think one of the things we probably should just point out to our listeners is that house prices are more definitely a function of supply and demand.
Correct. Indeed, yes.
And it's less a function of how good the economy is going or inflation and GDP labour markets. And the other thing everyone's got to bear in mind is that it's much more affordable now because we've had 2 rate reductions.
3 rate cuts.
3 rate cuts. Sorry, 3 rate reductions.
And just by the by on that, the house price story, that it is the RBA does not target house prices.
No.
They only look at them from they tend to look at them from a wealth effect, that I'm feeling wealthy, so therefore I'm going to spend more. And I'm not going to say they're going to hike rates because of house prices, not at all. But in their function of, their checklist of things that they look at, they'll be saying, they don't want house prices to go up by 10%, put it that way. They prefer them to be 5%, rather than 10.
So house prices are going up by the more modest number.
They are at the moment, but so maybe I've been a bit hawkish on that one. But
if house prices but you're right though. But if
they start going up 20%, we don't want that. No one wants that. It's like getting shots at 2:00 in the morning at the bar. You don't need it. You've already had a fun night.
But on that one of Kookie, I probably put house prices in neutral because I think because I think they're going at up at a much not as fast, but a faster rate. So
and they were weak at the start of the year. We had a few months where prices actually fell according to the Cotality price series,
which is the old core logic.
The old core logic numbers. Retail sales, I'm putting that towards neutral because we have had a pickup in consumer spending.
Better than it was.
Not great, better than it was. You certainly wouldn't hike. They might even be erring towards easing. This is where this dilemma and the judgment comes in from the Reserve Bank Board. Consumer sentiment, putting that towards similar to retail sales, was down, lifted, and just started dipping the last couple of weeks. The ANZ measure is just a bit weaker. Building approvals, I'm going to keep that at neutral. Our long-awaited pickup in housing construction has had its green shoots. Heaven knows we need to build a heap more buildings over the next 5 years. And recall the government has a target of 1.2 million dwellings for the next 5 years.
I think they should revise it, to be honest. And I tell you why, because
it's too high.
It's too ambitious.
It's too high. Yes.
Yeah.
Well, mate, I want to play second row for South Sydney next year, but I don't think I am. Maybe
you might get a run,
but I don't think they're going to build 1.2 million houses either.
No,
they're not.
No.
So I've revised my expectations for South Sydney down. I'll just watch it from the sideline. You're quite right that 1.2 million ain't going to happen. Business investment, I'm putting that in easing. We mentioned this before. Business investment has been frankly disappointing, and I'm not throwing stones at the business sector. They've not invested for a whole lot of reasons. One, because interest rates were high recently. The economy was weak. Why would I invest all this money in new machinery and equipment if the economy is really weak? But we need that, CapEx to lift that productivity. Business confidence, similar. It's picked up a bit, but not too bad. Commodity prices edged up a bit, but they're only neutral. Stock market's booming. I'm just going to leave that at neutral. The RBA doesn't target that. Current interest rates, as you said, are restrictive. Not as restrictive as they were 6 or 8 months ago. Erring, if I can lean across that far, sort of towards an easing. So we need 1 or 2 more rate cuts to get to a neutral setting.
And the last conversation by the RBA was that interest rates are still restrictive. They're not. They haven't.
Correct.
They haven't gone any other direction. They still continue to use the word restrictive.
Correct.
As opposed to stimulative.
Yep. Which would be sort of like a 2.5% official rate.
Or as opposed to neutral. They haven't said neutral or stimulative.
No. They haven't said neutral yet. No. So still the 3.6 official cash rate, which is where we are today, is still restrictive.
Still restrictive. Now, final bit. Great, but the next Reserve Bank meeting is at the end of September, but it doesn't seem they're going to have much more data, and therefore the next lot of data that's going to come out, as we said earlier, quarterly data comes out at the end of October. which sort of bleeds into the Melbourne Cup Day meeting they hold every year, which is is it still the second last or now last?
It's the second last. It's the 4th of November, Melbourne Cup Day. And then I think it's the 9th of December is the
Right,
last one
last
for
one.
the year.
So they
Yep.
still have a December
Until
meeting
February
next
2026.
next year. So, I don't know what the hell it is, but it's always seems to be something comes our way in November, one way or the other, up or
Remarkably
down.
common they do something at the
It's got something to do with the end of the quarter data that comes out
Correct.
for the
You nailed it.
September quarter.
Yep.
So, do you reckon that right now, irrespective of this, there'll be no change and they'll wait until the November meeting?
No change in September. They've just, as we alluded to, the numbers that have come out since the last cut, 6 or 7 weeks ago from the RBA have been okay. There's not, if the numbers had deteriorated and that inflation rate was really, really low and the unemployment rate was really, really high, yep, you'd say September is a high probability of a cut. But I think when we wait till that Melbourne Cup Day, and as you said, that at the end of October, I'll just check my dates, end of October, we get the September quarter inflation numbers. If they're showing that the trimmed mean, the underlying inflation rate's at 0.6 or 0.7 quarter on quarter, the annual will drop to 2.5, slap bang in the target range. And we do get another unemployment number, of course, between now and then. If it shows a little bit of an uptick in the unemployment rate, they'll be cautious, just 25 points again. We're not talking more than that. And that'll make that for 2025, we've had 100 points of rate cuts.
And that's, to me, sweet spot.
I think then we'll be at the sweet spot. Again, fast forwarding to December, gosh, let's see if we get the next couple right. They'll probably be on hold and then revisit everything at the start of 2026 because they'll know they've got 100 points of cuts in the pipeline. They'll know that the economy is looking a little stronger. The rate cuts are working. Do we need to do many more? Well, let's revisit this in February 2026. I think that's how the board will approach this next couple of meetings.
And if someone asked me the question, because I'm hoping, I should say, that's what happens. What you just said, we get another rate cut in November off the back of good trim mean inflation numbers that come out at the end of October. And I'm hoping GDP and labour markets are in the right spot as well. My view is that there will be no more rate cuts. And the reason I say
after that, one more and then none. One and none.
That's it. And the reason I'm saying that,
Yep.
or I'll put it around the other way, the only way we'll get another rate cut if something happens internationally. Right. That's going to affect our position in Australia in terms of exports and everything else we do in the world.
Sure.
Because we are doing very well, relatively speaking.
We have come through this period, and as I alluded to there, I think I might have to have a bit of humble pie and say the Reserve Bank probably has managed it better than I gave them credit for.
Yep.
And that's my era.
In terms of speed.
Yeah.
Well, you and I really reflecting on speed.
Yeah. Yes, and that's even allowing for the fact that the unemployment rate has kicked up, that inflation is low and falling. But I think we're getting really close to that point. I can't disagree with you because maybe we do need those two cuts. Again, it's only maybe.
Yeah,
it's only maybe. I think we definitely need the one more to get us back to neutral.
Yeah, I think so.
And then the RBA might sit there, and this is the other thing that we've learned looking at the RBA over decades, frankly. Once they get rates where they want them, they hold them for a year. So 2026 might be the year where we see no more changes. There might be one up, one down, whatever. But we might be in this period that there'll be no change in rates. We're getting close to that point now.
And to me, that's good because
that's good. It's certainty. Yes.
Well, that puts us back to the old system that you and I were used to.
Yep.
5 rates up. Flat period, 5-6 rates down.
Yeah,
but more gentle.
So it's more.
Yeah, there might be a change, but that's where everybody wants to see us.
I like that. And again, the other thing that we've learning during the pandemic and the inflation surge a couple of years ago, aggressive and frequent rate adjustments, either up or down, are not good news. It's just a couple up, a couple down. That's fine. We can all live with that. It's when we saw those rates cut to next to nothing, effectively zero, that created a problem. We needed rates because of the pandemic. Then they hiked them 400 points in barely 18 months. That created a problem. And now we're getting back into this even keel where, every 3 months we'll tweak it down 25, might hold. And so the discussion on interest rates is really more about another 25 or 50 or nothing. So we're not talking hundreds of points of rates.
I mean, we'll have nothing to talk about.
Oh, we'll have plenty to talk about,
They'll
Mark, because we what we didn't talk about
They'll put us
today?
out of business because we love talking
The
about
budget and how the government can influence the Reserve Bank, not in terms of political pressure, but in terms of economic policy.
Fiscal
We've
policy,
heard, and we've got the mid-year budget update coming in. I think that's in December.
What do they call it?
MYEFO.
MYEFO.
Mid-year, MYEFO.
Comes out in December.
And, and with this productivity stuff, the productivity roundtable and a few other bits and pieces that are occurring, they have an impact on the economy, Then and
Big time.
bloody oath, big time. And so you get this conversation going about whether the government, and this relates to employment, by the way, and I'll shut up shortly. But one of the reasons why the labour market was so strong in the last couple of years, and I think we touched on this last time, was that the Albanese government, and some of the state governments hired heaps of people in the public sector or public sector related industries, nursing, aged care, teaching, NDIS, all that sort of stuff. And there's nothing wrong with that. But it created a superficially strong labour market. My observation, I think I've heard this from Treasury and a few other people, is that all of that hiring's done. That all the nurses that we needed for the aged care facility is done. If anything, they're trimming back a bit on NDIS too, or the growth in NDIS, I should say. So if we get to this position late this year, early 2026, and government employment reverts back to almost zero, and the private sector hasn't picked up the slack in terms of hiring, these labour market and wages might be an issue that just sort of emerge again. So we can talk about the budget and what they're going to do with employment, what they're going to do with do we need a surplus? Do we need a deficit? A lot of things there, mate.
Well, I should let you know that I've retained an actuary to revisit Paul Keating's structure from 1993 when he introduced the super guarantee the amount of super you need to put away from, say, the age of 20 to the age of, say, 65. So there's assumptions in there.
There's assumption, fair enough. Yeah, no, that's fair enough.
Assuming the average Australian male, just in relation to the male, obviously female as well, but dies at 81.2 years of age.
Right, yes.
What happens if they live to 91? So how much more super would we need to put away to maintain that last 10 years?
When are you getting the results of that?
No, I've only just retained this week. Okay. I spoke to him this week and I'm actually going to share that with you, but I'll share it in one of our episodes. But I want to share it with the government. I want to say, look, because
we're living longer.
Yeah, we're living longer,
which is good.
And I do get it. I sort of understand why someone today's got more. He's got more than $3 million worth of assets, and they're 70 in their super.
Yep.
I get it. Maybe you've got to pay tax. I get it. A bit of redistribution of wealth. I get it. Right? But if you're 20 and you're saving now, and you will have $3 million when you turn 65, you probably need more than that because you're going to live another 10 years. I'm saying maybe we've got to be encouraging those young people to have 5 million before they start. So this is an indexation question.
So I'll have to think about that, but I love the concept that, a 70-year-old, let's just say they've got 3 million today, a 70-year-old in 2075,
50 years time,
3 million won't
cut
enough.
it.
No. They'll probably need. This is where the actuary's going to do some fantastic. They'd probably need to have 6 million. I don't know, whatever that number is.
So therefore, we should encourage more money in there.
Have it stepped up, yeah. Because as I said before, I'm a big fan of super. I think it's a really important policy.
Not at the expense of.
No. But it's generally a good idea. That superannuation, the 12% contributions, and all that sort of stuff. Great.
And I'm not saying employers should have to pay more. I'm not suggesting that. But
no.
But what I am saying is that maybe there needs to be some other incentive for employees to put more money away. And I don't know what that looks like in terms of tax policy, whatever. That's for them to work out. But I just thought about time someone to do that because I just think that Keating's hypothesis was based on the average age of an Australian male or female.
Yes,
and that's changed.
It's changed by a lot.
A lot.
Dramatically.
In fact, 30 years ago, Steve, it was generous to assume someone's going to live to 81.
Yes.
Today, it's not generous.
No, it's extraordinary.
And if you take Keating's hypothesis, maybe we should be assuming they're going to live to 91. Be generous again.
Yeah.
Because you might as well be that way, because otherwise, I can tell you what's going to happen.
Yeah.
They're going to turn 81. They've got nothing left. They're going to live to 91, and the government's going to have to tip in.
Again, yeah.
And we're going to have a liability.
One of the reasons for superannuation was to get people off the public pension.
Totally.
You know?
Which is why our system is globally recognised.
Yeah. Why don't you get Paul Keating to talk?
I'm hoping that this actuary will, what the outcome will be, and then I will ask Keating to
Paul to come
in.
Because that's his baby. Yeah, he
mate.
loves superannuation more than anything.
And what's interesting is if Paul Keating talks, the Treasurer will listen.
People will listen. We all will, mate. I'll tell you what.
No, but for the obvious reason, and because I'd like Australia's superannuation system to remain the golden standard for the rest of the world forever, not just today.
See you, Mark.